Well, hi everyone. You've joined in. We've got a pretty good guest list today, and I love to see that. It's actually been a minute since I've had the privilege of hosting one of these webinars. Allie Smith, one of the other specialists here at the center, typically runs these. She's out of the office this week. So you know what? I'm going to fill in. It's going to be great. We're talking about a really important and often misunderstood topic in personal finance. We're going to cover credit today, okay? So to get us started, we'll do some introductions. I'm going to say hello. Aiden will say hello. And we're going to kind of kick off, since today is Halloween, with some creepy, like Jeepers Creepers credit features. We're going to look at a few credit facts to get us in the mood for talking about this sometimes scary topic. So today's date is totally fitting, if you ask me. So Aiden, if you actually want to just start and introduce yourself and explain a little bit about what you're going to be doing, and then everybody else who is joined in, there's going to be a poll that I will have you start responding to right now. So go ahead, Aiden. Thank you.
Yeah, of course. Good afternoon, everyone. I'm excited to be here. My name is Aiden Kamowski, and I am currently a student ambassador with the center. I've been here a little over 2 years, and I am a senior studying supply chain management within the business college. And today, during the webinar, I will be moderating the chat. I already sent in one message, just sort of welcoming everyone, but a ton more useful links and sort of referencing things that Sarah says. Also, if you have any specific questions and she's still presenting or whatever, I can try and address that and we can circle up at the end. But any sort of questions that you have, please put those in the chat and I will make sure to address those.
Amazing. Okay. Thank you. Thank you. Perfect, Aiden. And my name is Sarah Metzger. Like I mentioned earlier, I'm a financial educator with the Sokolov-Miller Family Financial Life Skills Center team. We're based here at University Park, and we are a student serving office for all Penn State students at UP, at the Commonwealth. I think I saw we've got maybe folks from Berks joining in here today, and a couple of other campuses. So welcome. I think York is maybe in representation here. So hello to York. We're really glad that you're joining in. We'll talk about our services at the end of this session. We're going to focus first on the big content, why you're here, and that is credit. So in a moment, we're going to share out these responses. I've got like a mini quiz for you, but don't worry, this is not for any actual grade, right? This is just an assessment for yourself of like, what do you know about the state of credit here in the US currently? And what are the implications for you? Like, why does any of this matter? Why does it feel so scary sometimes when we think about credit or we talk about credit? And what can Aiden and I share with you today to help you feel more empowered, more confident, and ready to really wield this tool, this financial tool that has a lot of terrific power? So I've got most of you all responding to the questions just for who are you? How much credit card debt are Americans holding on to right now? How many millions of Americans are considered credit invisible, meaning they don't have a credit record? And then kind of looking at 4 different types of debt, 2 different types of credit that have been issued to Americans, which has the largest balance and the smallest balance and kind of everything in between those 4 items. So we're almost there. You should be getting right answers as you are going along here. Like you're going to get, oh, I got it right, or oh, I didn't get that right. And that's okay. Again, it's not a real quiz. So it's just like for fun, for funsies. Okay. Just about everybody. I'll give you like another 15 seconds. Aiden, I don't know if this pops up on your screen, but by all means, like jump in on that. I don't know if you know the answers to some of these questions. Okay, I'm going to shut this bad boy down. So if you didn't get it filled out fully, don't sweat it. We're going to take a look at the answers together. So let me go ahead and share that back out to you all. So you're going to see who's in attendance today. I love to see that we have a really big representation from undergraduate students. This is a topic that in my work I have found younger students are super curious about, but there's just a lot of misconceptions. So I'm hoping to clear some of that up for you all today. We've got grad students, staff, and faculty, and some others joining in. Really excited that you're here too. For those of you who maybe have been immersed in credit for a longer period of time and you've got some advice to share, like go to the chat. This is a community learning space. So Aiden and I are gonna, give to you what we know about credit, but certainly we can all kind of lean on one another to share anecdotes and offer advice, or just kind of affirmation when we talk about our credit lives and like what credit is and how it works and why it matters, right? Okay, so on to the questions. How much credit card debt are Americans currently carrying in total? A few of you got it right. 4 of you got that right. The correct answer is $1.03 trillion, right? It just got bigger and bigger in those options, like a million, billions, but it's actually trillions. And that's updated as of second quarter of this year. So it actually was about a $45 million increase from the quarter before. So $1.03 trillion of credit card debt Americans are hanging on to. I'm sure actively trying to pay down for the most part, but still there. Number 3, about 26 million Americans are considered credit invisible in that they don't have a credit record. And there are also many more who are considered those who are with like a limited credit history as well. So this credit invisible situation is, as we'll talk about, challenging for others. Like to be credit invisible is going to, close doors for people in their financial lives. And certainly I wouldn't want a door to be closed in any of your lives, financially speaking. So we'll talk about why it's useful to begin building your credit worthiness and to not be categorized as that credit invisible individual, right? And then number 4, this was that rank choice feature. So we're kind of all over the board here, but interestingly enough, we have student loans as the largest debt balance. So many of you said that that was the largest, but another big portion of you said that that was the second largest. It's in fact the largest current balance, followed up by these retail cards, your store cards, consumer loans that are being issued to individuals. It's kind of like that other category that doesn't otherwise include student loans, credit cards, or car loans. And then third largest, we've got credit cards, and fourth largest, we have auto loans. So I don't know, maybe surprising to some, maybe shocking and spooky to others, or maybe you're like, I was just reading about this the other day, and you're like, I totally knew all of this. But I think what we're getting at with all of this information, these facts that I'm sharing, is that like credit is a big part of many Americans' lives. Almost all Americans have some line of credit. They're dealing with credit. And I mentioned it's a really powerful tool. With any kind of tool, if not used properly, it can be harmful, right? And so we're going to cover that today. We're going to talk about what credit is, why do we use it, how is it helpful, kind of going through those 5 W's, so to speak, okay? Now, if you have questions as we move along here, you're welcome to drop them into the Q&A. You are also welcome to drop them into the chat, but just know that you have an anonymous option in the Q&A if you'd rather not reveal yourself and kind of stay masked like all of the children will be when they trick or treat tonight. So yeah, let's proceed. There is a quick question I saw in the Q&A already. Mortgages on that scale are like in a separate scale. So that's considered household debt. Oh gosh, I was just looking at this figure earlier. I think what we're looking at in total household debt is something like $17 trillion. I'd have to double check that. I didn't pull mortgages into this, but it's up there. It's up there. And it's factoring into this household debt as opposed to non-household debt, which we looked at in the ranked choice question there. Okay, good question. Keep them coming. I love to see it. All right. So To be clear, like what kind of brings us here today, we all want to know a little bit more about credit, ask some questions, debunk some myths. Um, if this is also not a priority for you or a reason why you showed up today, I'm going to like encourage you to think about financial wellness for yourself and like give yourself a pat on the back, because showing up today to learn more about credit and to think about what your next action steps are going to be in this space of credit will help you build a healthy financial life. It's going to help you access security. It's going to help you access freedom in life in terms of like this lifestyle, right? Where you've got a credit card, good for emergencies. You've got a credit card, good for obtaining the things that you want in the moment, but otherwise aren't planning to pay for in that moment, right? So like you are putting a vacation on a credit card, getting that flight booked on a credit card, right? Allowing your life to be enjoyable. Credit kind of fits into that space, right? So kind of keep that in mind. Like we're talking about credit and it is an element of your financial life. And it's something that if like really managed well, you can leverage to improve your overall financial health. Okay. All right. Oh, and good. Aiden is popping into the chat. Yep. That total household debt, that 17 trillion. And mortgages are about 2 trillion of that. Okay. Perfect. Thank you, Aiden. I really appreciate that clarification. So the individual that asked that question, there's your answer. So let's move on, right? We've got financial wellness in mind. We want to get to that space. We see the definition of it, and so we can evaluate our own health, financially speaking. When talking about debt, where does this kind of fit in to the bigger picture of like money moves that you're making and financial priorities that you have, right? Allie, who normally runs these webinars, talked early on this semester about the importance of having a spending plan, having a budget set up so that you're able to save a little bit of money. Having that budget set up is really important for leveling up to this space of considering debt and thinking about credit, because your budget is what allows you to know whether or not you need to take out a line of credit to borrow money. It's also going to make it possible for you to repay money that's been loaned to you to pay your debts back, right? And Allie talked about debt 2 weeks ago if you were tuning in. So we're talking about credit though in this space, and just kind of know like as you are maybe taking initial steps in this financial journey that you're on, before you even start thinking about getting a line of credit, like your mind should first think about creating a solid budget for yourself, saving money for your goals, saving a little bit of money for emergencies as well, and then leveling up to that next step. That's how we teach about it here at the center. I think it's a really solid framework. I encourage you to explore more by getting on our website, getting on our YouTube page to kind of see it in full. And keep tuning into these webinars because we will end up covering those full steps before the end of the semester, okay? All right. Yeah. Ladder to financial freedom. Love it. Okay. So getting into like the meat and potatoes of it all, like let's talk types of credit first, right? What is credit? What are the types? There are 3 main categories that I'm going to break down for you here. And some are going to sound way more familiar than others, is my guess. So the first type that we have is revolving credit, right? This credit is money being loaned to you. When you have a credit card, you are essentially being loaned money on that little card, right? Every time you swipe, you are borrowing the credit card company's money to pay for a good or service. And you are making this promise of, I will repay you when you send me the bill for it, right? And with revolving credit and a credit card, you get a limit. Every credit card has a limit, $500, $1,000. You are able to spend any amount within that limit, right? And continue to use whatever is remaining. So if you have a $500 limit and you spend 250, you still have 250 you can continue to spend. And that limit and the ability to borrow will continue to revolve as long as you continue to make payments towards the bill. So you swipe for 250, you pay 250 back, you've got 500 available on that card to spend, and you continue to cycle through that, right? Hence revolving credit. Very common type of credit. Many of you are going to, if I had you raise your virtual hands, you'd say, I have a credit card, right? Another type of credit, this loaned money, is installment credit. And installment credit is a home loan, a car loan, a student loan, any type of credit that is issued to you that has really set fixed terms. A lump sum is given to you, and you are expected to pay that back in monthly installments for a fixed period of time. So those of you with federal student loans, there's a standard repayment plan. If you borrow $10,000 in student loans, you are going to be expected to pay back that $10,000 in 10 years, and every month you'll have a fixed payment, right? That is installment credit. Open-end credit is something you may hear, but I think it's one of these kind of least understood types of credit. Like, what are examples of open-end credit, also known as open credit? And in this case, we've got a product that is working similarly to revolving credit. We've got products that are working similarly to credit cards, but it's not exactly a credit card. It's a kind of loan that a borrower can draw money from repeatedly up to a certain pre-approved limit. So this could be something like a personal line of credit or a home equity line of credit. There is no fixed end date for repayment, and there's that predetermined limit that a borrower has available. And so similarly to a credit card where you use a little, you pay some back, use a little, you pay it back, open-end credit in the form of like a personal line of credit or a home equity line of credit works in a similar fashion. So I'm not going to talk a ton more about like home equity lines of credit or anything like that, but I do just want to give a nod to these products because somebody did ask a question about mortgages. And so maybe we're thinking about, like, we've got homeowners in the room here. So just to be really clear, a home equity line of credit is one of these open-end types of credit in which your home serves as collateral and you are going to be able to borrow generally up to like 85% of the value of the home minus anything that you owe on it, right? They can be really useful if you need to access money for things like home repairs or renovations, but you don't necessarily need that money all at once. Maybe you need $50,000 for renovations, but you're going to pull some of it out piece by piece and then make payments back bit by bit, right? Different from this, and you maybe have heard of a home equity loan. So just to clarify, a home equity loan is not the same thing as a home equity line of credit. A home equity loan is a closed-end loan, meaning it's got that fixed repayment. It's got an end date that loan needs to be repaid by. It's installment credit. It's a lump sum. So if you got that $50,000, you're getting it all at once, and you'll need to pay it back over a fixed term. Whereas that that home equity line of credit is open end, and you can continue to borrow and repay and borrow and repay in that cycle. Okay, so that's all I'm going to really say about home equity lines of credit and home equity loans. If you've got more questions about mortgages and things related to home buying, you're certainly welcome to ask those questions. But Allie's going to have a great webinar coming up in, I believe, the spring semester on that. So that'd be a great place to check in, or just shoot us an email, set up an appointment to meet with us. Let's talk it out. But we're going to move forward beyond these types of credit. So now that you know the three main types, how would you access them? How do you get a line of credit? And, in a really simple sense, like between friends, you could go up to a friend and like, hey, can I borrow $20? And they tell you yes or no, right? And there's that kind of quick and easy transaction. It's not generally as simple with lines of credit, official lines of credit from lenders or creditors, because there's more paperwork involved. You're going to have to bring some documentation. You're going to have to make a request to open a credit card or take out a car loan, right? You're going to have some information on the front end in order to make that contract complete, right? But there is another party here. So you are engaging with some lender, a credit card company, the federal government, if you have student loans, maybe a car. What am I trying to say? A car, not a manufacturer, but the financing office of the manufacturer, like American Honda Financial, who I make payments to, right? So you've got that other party, and between you and that other party, there's this exchange where they're going to give you some money, either a lump sum or a limit, and then you are going to pay back in installments or pay back based on minimum balances and due dates, that money to the lender, right? It's very simple. It's very simple, which makes like using credit not difficult, right? There's generally not a lot of like heavy lifting mentally that we have to do to use a line of credit because the process is simple, but like understanding, okay, what should I be mindful of? Like what's important here? What should I watch out for? That's where things can sometimes get a little complicated. But before we get to that, let's just be really clear about why you would want to use credit in the first place. Many of you are going to say to me, well, Sarah, I have a debit card. I've got a checking account. Like I've got my money and I can use it whenever I need it. Like what would be the purpose of opening up a credit card or taking out a loan? And I would say like there's at least 5 main reasons why, and we've got them listed on the screen here, right? So like number one, having a line of credit makes paying for major expenses much easier, right? College tuition, a new car, buying a home. Most of us do not have that amount of money just available in cash in our savings account. And so we need to take out a home loan or a car loan in order to get that good or service, right? Financing unplanned expenses also can be more easily done with a line of credit. Credit cards, for example, make covering emergencies much easier if absolutely necessary. Asterisk, like caveat here is have an emergency fund that's accessible so that you don't always have to rely on your credit card in an emergency, but having one certainly can be useful, right? It makes it easier to buy the things that you need right now in the moment. It just got really cold up here in State College, and so folks might be running out there to buy a coat. The spring semester is coming up, getting a book last minute, having a credit card could make that useful. It also makes it easier to engage in the online marketplace. Those of us who want to shop on Amazon and elsewhere really can't do so without a credit card. I mean, now certainly you could use your debit card if you have one, but hey, one of these other added benefits, and gosh, I'm surprised we don't even have it as a bullet point here, is like, well, if you use your credit card and it has a rewards program, maybe you're getting rewarded for that transaction that you were going to otherwise make with your debit card. But hey, now you get some cash back or you get miles to use on an airline because you made that transaction with your credit card instead, right? All of these could be, good and valid reasons for you. This is what makes having credit so powerful, right? But also using credit, and I'm going to get to this last bullet point, using credit is helpful because it allows individuals to build credit worthiness. And so we're going to talk about what credit worthiness is. There's credit, which is the money that is loaned to you, right? That line of credit is money that is issued to you that you are promising to repay. Credit worthiness is how worthy you are to be loaned that money in the first place. It is a reflection of your financial responsibility, and it is presented in the form of a credit score. So this credit score that exists out there, if you have a line of credit, you have a credit score. If you have a student loan, if you've got a credit card, if you've got a home loan, a car loan, if you're on a parent's credit card, or some other authorized user of a card, you probably have that credit score out there. It is a rating, generally on a scale of 300 to 850, which we'll look at, that is telling lenders about your credit worthiness. Like how likely is it that you are going to repay the money that they loan you? How much can the lender trust you? So it's at this point where kind of a catch-22 pops up that like, Okay, Sarah, wait, you're telling me that if I get credit, if I get a credit card, I can start building my credit score. And having a nice high credit score looks favorably to lenders. Lenders want to see that. They're going to trust me enough to loan me money. But if I don't have a credit score, how will I possibly get a loan or a credit card in the first place, right? And so there is this catch 22 there with the credit system in the US that like it's sometimes hard to get credit because you don't have credit, but you can't get credit because you don't have it. I fully understand that. So I'll talk a little bit more later about how you could go and more easily begin to obtain credit and build a credit score for yourself so that it's not as challenging in the future when it comes time to buy a car or buy a house, that you've got a nice and robust score. But before we even get into that, like, let's just be clear about what is influencing this score, right? It is made up of several factors. It is made up of the mix of credit you have, installment versus revolving credit versus open-end credit, how well you are maintaining your payments, so making bill payments on time, if bills are late, if bills are not made at all. So if you're simply not making payments, like you're going to see that will have a bigger impact, right? Because that's 35% of your overall score, whereas the type of credit is a smaller influence since it's only about 10% of your score, right? And this is a scoring model that we see through FICO, the Fair Isaac Corporation. It's generally a breakdown that we see across the different scoring models that are out there, right? So you can see from this pie chart, like, okay, I want to build credit worthiness. My credit score is a reflection of that. I see that Sarah is saying 35% of my score is going to be influenced by my payment history. I need to make sure I pay bills on time. What about this amounts owed piece, though? Because that's like another 30%. That sounds important. What is that? And in this factor, what we're talking about is like credit utilization, how much money you're using and borrowing. So if you have, for example, a credit card with $1,000 limit, if that credit card is getting maxed out regularly, you're going to see your score probably lower. You're going to see it start to dip. And that is because your credit utilization, this amounts owed, is number one, a really big influence of your score. And number two, if you're maxing out a credit card, it's going to look, it's going to not look great to the lenders, right? It's going to suggest perhaps irresponsibility or poor management of that credit card. Whether or not that's true or not, it's a different story, but this is the reflection that we give. This is the perception that the lenders are going to have of us as individuals when we are maxing out credit cards or we are overutilizing our lines of credit, right? So kind of keep that in mind. There's a lot at play here, and scores are likely to fluctuate. And there are different scoring models out there, which means you're going to see different scores across the board when you go to places like Aiden linked in the chat, myficoscore.com, to look up your FICO score. You could go to Credit Karma. You can go to Experian. I'm hoping that Aiden will start to plug into some of these websites where you can go to figure out what your score is. And don't be surprised if you see some variation because there are just so many different scoring models out there, okay? All right. Okay, so we got a good question coming in here. Can you please elaborate on the credit type and how it affects your scores? So credit type, we talked about the three big types earlier: revolving credit like credit cards, installment credit like a student loan, and then open-end credit, which could include a credit card, but could also include something like a personal line of credit, a personal loan, or a home equity line of credit. Having a diverse mix of credit can actually benefit your score overall. That said, if you only have a credit card right now, that's okay. That's perfectly fine. It doesn't mean that you need to go and run out and buy a car or get a bigger loan for yourself to simply have that installment credit if you only otherwise have revolving credit in the form of a credit card. Have these things kind of happen naturally as life progresses, right? Like I didn't go run out and buy a car right away because I learned, oh, having installment credit will help my score. No, I like bought a car when it was the right time for me to buy a car and take out a car loan, right? But just kind of keep that in mind that it is a factor here. And generally, as we all get older, we end up, we aspire to buy a home. We may have to buy a car, and so we kind of naturally fall into having a more diverse mix of credit simply because we are getting older, right? If you have multiple credit cards, that's going to start to play into this mix too. And having multiple cards is not necessarily a bad thing. It really comes down to like, how are you managing them, right? If they're not well managed, you're going to see that reflected in your credit score. Okay, that was a great question. Please send some more through if you have them, because credit can be such a murky topic sometimes. So we've got this credit score better understood. It is a reflection of your credit worthiness. Having a good score is what's going to help you get a line of credit, a credit card, or a car loan in the future when you need one, or want one, whatever, right? This range I mentioned to you, this 300 to 850, the higher the score, the better. Having an adverse credit score, so a subprime score, isn't going to be necessarily the end of the world, so to speak, quote unquote, but it certainly can throw up some challenges for individuals in those circumstances. Having a poor credit score reflects, it's a reflection to lenders that as an individual, you may not be trustworthy, that they may not wish to, give you a credit card, approve you for that credit card, or authorize a loan for you, right? And that can be really challenging. It may make it difficult to buy any kind of car for transportation to and from work. Landlords also check credit scores, right? They want to make sure that their tenants are going to pay rent, and having an adverse credit score may make it very difficult to obtain housing. So certainly, like, taking actions to keep your score nice and healthy is so important for the moment, like the immediate moment, but certainly also for down the road, like the big goals that you have. As a student, you want to move off campus, you need a healthy credit score because landlords will be looking at that. Or you want to get an apartment after you graduate, landlords will be checking. You want to buy a car, buy a house one day, like, to keep your goals on track, make sure that you have a strong credit score to match that, right? And time is a variable here, right? It takes time to build a nice, healthy credit score. But the more positive interactions you have, the more you pay your bills on time, the more you keep your balances low, it's going to help your score increase. And that's going to make it easier to get housing, to get more credit in the future, to get a really good interest rate on a loan in the future, a good car loan interest rate, a good home loan. Like, there's just generally more benefits built in there, right? In the same kind of way we see that with like academic GPAs. So there's an easy kind of analogy, right? We open doors with high academic GPAs, we close them with low academic GPAs. The same is true for your credit score, this financial GPA of yours, the higher the better, right? All right, so we got a question coming in. If you have student loans, an auto loan, a mortgage, and credit cards, would it make sense to get a personal loan to pay off credit card? Okay, I'm going to come back to that question at the end because I think that's a bit of a longer question and I don't want to get stuck on that in this space, but I will come back to you. Okay, so hang tight on that. Let's keep moving forward and talk about those behaviors that can hurt a score. The best thing you can do for your credit score is pay your bills on time and keep your balances low, right? That is like the best thing that you can do. Things that are going to lower your score temporarily are going to include, missing a payment, having a late payment, maxing out those cards like I mentioned. Interestingly enough, too, applying for lines of credit will temporarily lower your score. Applying for a credit card or applying for a loan. Defaulting on a loan, certainly has a greater impact, right? That's just straight up not paying your loan bills at all or your credit card bills, and having a defaulted loan or a defaulted account or pursuing bankruptcy. That's like kind of the worst that it could be, right? Those are going to have the biggest and most long-term impact on your score in a negative way. But generally speaking, all of these kind of interactions we have, whether we miss a payment or we make payments on time, those are only going to stick with us for a temporary period of time. They're only going to stick with our score for anywhere between 2 and kind of 7 years. And what I want you to understand about your interactions with credit is that if you make a misstep, if you miss a payment, it's not going to be the end of the world. Even if you miss a couple of payments, it's going to probably lower your score temporarily, but that score can improve as you start to stack more positive interactions with your credit. The more bills you pay on time, the less of an influence that missed payment has on your overall score. Just like an academic GPA, right? So we've like been trained our whole young adult lives to understand credit because we understand GPA, right? So kind of keep that in mind, that there are things that are going to influence your score positively or negatively. The more positives you have, the better. They'll outweigh the negative interactions, the missed payments, or maxing out that credit card for a month because something unexpected came up, right? The more positive interactions you can accrue for yourself, absolutely the better. Okay. So where is all of that kind of housed? Like, who's keeping record of those missed payments or those on-time payments? And where is the score being generated from? Back to this analogy of academic GPAs, you had a transcript in college, right? Well, you also have this like financial transcript in life, and that's called your credit report. And that is where all of your lines of credit are stored. The information is contained within it, right? And within that report is also going to be the list of all the payments you've made, any payments you've missed, how much you owe, et cetera, et cetera. And it's from your credit report that you are going to have scores generating. There are 3 types of reports out there. They are maintained by the 3 main bureaus in the US. We call them credit reporting agencies: Experian, Equifax, and TransUnion. And these are kind of like the big brothers, so to speak, where they are getting information from your credit card company, from your bank, from the federal loan servicers, from the individuals who are maintaining those lines of credit that you are expected to be repaying to. Those entities report to Experian, Equifax, and TransUnion about how you're doing. And then from these reports, your score is generated, right? It's also going to have personal information within the credit report, which is to be expected, right? Because your credit report is tied to your social security number. It is you and your identity and your interaction with your lines of credit. And so you're going to want to, be able to check out like, hey, that's me, right? This is my credit card showing up, like everything is as it should be. To be sure of that, make sure you check in on your credit report at least once per year would be our recommendation. You can obtain 1 free copy every year from each of those agencies. So Experian, TransUnion, Equifax. You can access them online or by phone or mail, whatever your preference is. So maybe take a screenshot of this page or plan to go to annualcreditreport.com in the future to peruse those reports, to pull that report, to make sure that everything checks out. It is your way of preventing, well, I can't say preventing, but your way of identifying identity theft, right? So you could spot identity theft in looking at your credit report, right? You could see if somebody opened up a credit card in your name, but you're like, that's not my credit card, I don't use that. And it's also a good idea to pull your report to make sure that there's no nefarious activity and that everything that's reported is accurate, so that when you go to buy a car or buy a house, you already know, like, yeah, my credit is going to be in good standing. My report looks good, therefore my score is going to look pretty good. Like everything is as it should be, right? And if it's not, if there is information that is erroneous within the report, there's action that you can take on that. So I'm going to get to what to do if there are errors, but you're only going to know if there's errors if you review it, right? So when you pull that report from Equifax or TransUnion, Experian, whomever, you're looking for your personal identifying information, your address, your work history, right? You're looking for all of your debt payments. So every credit card, every student loan, well, if you have multiple houses, every mortgage, or maybe you have a secondary mortgage with your home, or you've got a couple of car loans, like all of that is listed and all of your payments are listed there. Going, not all the way back maybe to the beginning of that credit. If you got a credit card, 20 years ago, you're not going to see 20 years worth of payments. But like I said, you're going to see those 2 years or upwards of like 7 years of payment history. And you want to make sure it all checks out. If there is an issue with collections, if you have a line of credit that has gone to collections, you're going to see that appear on there. Any issues with bankruptcy, you're going to see that on there as well. If there have been any lawsuits, those may appear as well. If a judgment has been found against you, it's going to show up. And hard inquiries as well, right? These applications you're filling out for a credit card or for a loan, they're going to be reported to the agencies, and that's going to be contained within your credit report. Soft inquiries, right? Looking at your score whenever you want, looking at your own credit, that doesn't do anything to your report, nor does it do anything to your score. But when you are pursuing new lines of credit, we call that a hard inquiry, and that's going to have a place on your credit report. Okay. A question that just rolled in, a simpler one. None of these provide the FICO score. Is that correct? How do you get that? So FICO is a specific score provider, the Fair Isaac Corporation. Your FICO score, what you end up seeing on like, the Experian website or Credit Karma or your bank app may not be a FICO score. FICO scores use proprietary models, like scoring models, so they don't really like to just give that information away, but it doesn't mean that you won't necessarily see a FICO score. So for example, Experian will show you your FICO 8 score. Okay, it's an older scoring model, but they'll show you that score. It's otherwise not as easy to just see a FICO score straight up because, again, it's a proprietary scoring model, and it's generally going to be the lenders who are going to look at that information and request that information, right? But keep in mind, like, despite these different scoring models, FICO versus oh my gosh, Vantage 2.0, I think, like, there are these different organizations and different models. They all generally are looking at the same factors, right? That payment history, amounts owed, types of credit, age of credit, and number of new applications for lines of credit. Those 5 factors are generally the same across the scoring model. So there may be some variation, but I don't want anybody to get hung up on like, oh, I can't see my FICO score. Your lender may not even be looking at the FICO score. It varies by lender. So it gets a little in the weeds here. But certainly, like, let's hash that out at the end. Let's keep going, but let's hash that out more if we need to. I mentioned that credit reports could have errors. It is entirely possible. You can fix them. It's nothing to stress out about too much, right? But it will require you to take some action. You will actually have to contact the credit reporting agency in writing. That might be like physically written in snail mail or in writing on their website to let them know that there is an error on the report and that you dispute that error. If it shows that you had a missed payment last month, but you're like, no way, I paid that on time. I paid that credit card bill on time. Like, okay, you're going to need to notify Experian or TransUnion or Equifax of that error, dispute that, and work together with the credit reporting agency to have it removed or corrected in whatever way on your report, right? If things can't be fixed like you expect them to, or there are real things on your credit report that actually just have, they have a harmful effect, like those missed payments, maybe a period of missed payment that, are true. Maybe you did miss those payments. You can always plug in a note on your report explaining that chunk of missed payments, for example, so that any lender who looks at your report when deciding whether or not to issue you a credit card or issue you an auto loan, they will read that note and go, oh, I see that Sarah missed 3 payments on her credit card last year, but she has a note explaining that she was, I don't know, I was sick, I was incapacitated, and I was dealing, with a health emergency that made it difficult to make those payments on time, whatever it may be, right? You can document that. And certainly if there's an issue with identity theft, you need to take action on that right away and report to the FTC as well as the credit card company, and any other involved parties that there has been fraud, and that fraud needs to be taken care of, okay? All right, so I'm gonna wrap up before I go to the Q&A and just share out some extra credit considerations that are important, but I don't know if they always get the airtime that they deserve, because we've kind of covered the basics around credit. But let's dive in a little bit deeper to first payday loans and APR, and what is important here. Number one, I want you to understand that APR, the annual percentage rate, it is going to give you an idea of how much that line of credit will cost you, right? Your interest rate, it may also factor in fees depending on the type of credit you're pursuing, but it's going to kind of give you that apples to apples way of comparing credit options. There are tons of credit cards out there. There are tons of home loan options and car loan options. Like, which line of credit is going to be best for you? Think about APR as one of those factors, okay? Compare the APR, the annual percentage rate, and understand how APR works. I think this is especially important when we talk about payday loans and the risk that individuals take when borrowing payday loans. They're a type of installment credit. For example, when you borrow a payday loan, oftentimes it's a really high APR, like something 390%. It could be higher. We generally don't see credit cards with APRs that high. Most APRs on a credit card are going to be like, I don't know, 17, 20, 25%. But payday loans have really high APRs. And when we talk about APR, it's an annual percentage rate, but it's calculated daily. So you'll see that in the little math example on the screen, that whatever your APR is for a line of credit, you're going to divide it by 365 days within that calendar year, and then you're going to get your daily rate. That daily rate is going to be attached to any outstanding balance that you have. So for example, if with a credit card, if you have in a 25-day billing cycle, a $2,000 average daily balance, that 1.068% like would be attached to that, or whatever the daily rate is. And in this example, if an individual borrows $1,000 and they aren't able to pay that $1,000 back right away, for every day that they are holding on to that debt, we can see the daily rate building up $320 of interest in that first month, right? Which is why payday loans can be so harmful to individuals. And it's challenging because they're often really easy to access. They usually do not require a credit check. Folks just go in there with their ID and some information from their bank accounts, and they can get these loans. But good gracious, like $320 in interest over 30 days could be really harmful to a lot of individuals, right? So I just want to give that note about payday loans and APR. And then also a mention of buy now, pay later, these BNPL programs, which are often built into like this deferred payment. You see them online, you are shopping the marketplace, and you see, hey, with Klarna, with Afterpay, don't want to spend $400 right now? No worries. You can make a $100 payment every month for the next 4 months. That's buy now, pay later. What's important to understand is that these products carry fees for late payments in particular. And so while they might seem like, oh, no big deal, I don't have to pay interest on this, like this is a really cheap way to get credit and use it and get something I need now and pay for it later. but there are a lot of fees built in. Returning your merchandise can be very complicated when you use buy now, pay later. They have fewer protections. So credit cards often, because they are regulated and credit companies are regulated, there are protections built in for consumers, but we don't really see those types of protections across the board with buy now, pay later. So there can be some risk. And there also is varied impact on your credit score. Some buy now, pay later programs are not going to report a missed payment to the credit reporting agencies, and some will. So it's not universal. And I just want folks to be mindful of that. If you heard, oh, just use buy now, pay later, just use, whichever program, like it's fine. It's okay if you don't make your payment on time, it won't hurt your credit. That may or may not be true, right? So just kind of enter into that space having done your research, right? Okay, so I covered a lot of ground here. I want to go back to some of these questions. We have one-on-one appointments, like that may be a space that you come in and chat with somebody like myself or Aiden in the chat a little bit more. He's a certified peer mentor. But before we send you to do those one-on-one appointments, let's look at some of these questions here, right? Because let's answer what we can in the moment as we start to round out. So I talked about getting your FICO score. So a question just came in. Should you close credit cards that you are not using? I'm going to go back to this slide for a moment. Your credit age is a factor in your overall credit score. Your credit age is an average of all of your lines of credit. So if you have a credit card that you opened when you were 18 years old and you're now 33, I'm using myself as an example, it's a good idea to continue operating with that card, to keep that card open and active, because it is, at least in my case, giving me the longest average credit age. If I actually did do this. I did close my oldest credit card before I better understood credit cards and credit scores. And so I lost my average credit age, like it dropped. And so I saw my score dip a little because of that. And had I known better, I would have just kept my oldest credit card open, right? So you have to be strategic here, right? If the credit card is charging you $95 in fees each year and you never otherwise use it, maybe that's not the card to keep open because it's a cost to you that may be otherwise unnecessary. But just know that closing out lines of credit, closing out credit cards, or finishing out installment loan payments are going to influence this credit age category. Okay, so proceed with caution before you make a decision on closing out that credit card of yours. If anything, if it's like a nuisance, go put it in the drawer. Or you could be like somebody I knew in college and literally freeze it in a Tupperware in the freezer and just like break in case of emergency kind of thing, right? Do what you need to do. We got another question here. Someone mentioned in a workshop last week that 3 non-personal inquiries into your credit report within 48 hours only counts as 1 credit inquiry. Think about car shopping for the lowest interest rate. Is this accurate? Yes, I cannot confirm the time frame, but when shopping around, like for a home mortgage, for example, yes, that if you are going around and you are looking for a few different options, home loan options, and you're wanting to make those comparisons of like who is going to give me the best terms for this home loan, for example, and they're pulling that information, they're looking into your credit report, that yes, that does, what am I trying to say? That is going to consolidate down to, I believe, 1. Aiden, if you can just double check on that for me, I want to make sure I've got all of my facts straight on that one, right? Yeah, like, so, oh, I don't know what Aiden was maybe sharing here, if that was related to this question.
Oh, hi, Sarah.
Yeah, go for it.
So yeah, I was just looking that up. Yes, for when you're applying and looking for an individual loan, like a house loan, you're not going to take out 5 loans. You're taking out 1 loan. So looking for 5 is within, I don't know the time period, but a short amount of time. is seen as one inquiry. Same with a car loan because you're not going to be taking multiple car loans, just the one. When
Right.
it comes to individual loans, though, like if you apply for 5 different credit cards, that would be 5 different inquiries since they're all five. You could potentially get five, just for example.
Yeah.
So
No,
not, yeah,
that's good to clarify. Right. So we're talking about like a
not
specific
every loan
circumstance.
is bunched into one.
Yeah, we're talking about a specific circumstance like for home buying, right? Where
Yeah, that
you're
would be
like
one.
comparison shopping your credit options. Yeah. Good, good,
Yes.
good. Okay. All right. Now, back to one of these questions. If you have student loans, an auto loan, a mortgage, and credit cards, would it make sense to get a personal loan to pay off the credit cards so that their utilization is less? Feels like that is the only type of credit that I don't currently have. Um, I see. Okay. So this idea of like, could I take out a personal loan and then I have the third loan type, and so I have the most diverse credit mix? I would already say between having a student loan, an auto loan, a mortgage, and credit cards, you have a pretty diverse mix of lines of credit right there. And if you're looking to improve your score, because credit mix is just such a small influence, I'm not even sure if it's going to give you the boost that you would be hoping to see by taking out a personal loan and then paying off those credit cards, right? It also, to me, sounds like it would be just much more to manage. But I think you're kind of getting at this like strategy of like, okay, what can I do here to most positively influence my credit score? Um, if you know what you had mentioned in this question, that you want to have less utilization, with your like a lower utilization rate, this lower amounts owed, it may make sense for you or an individual who's trying to lower their utilization rate to open up an additional card to have that added credit limit, because your utilization limit is kind of all combined together, right? So if you have 3 credit cards and they each have a limit of 3,000, or that means you've got $9,000 in total available limit. And if you're only using, $500 a month on all of those cards, like between each, having that added card is going to increase your overall limit, which is going to lower the utilization in that moment. So it's kind of, we're getting a little bit in the weeds with it, but there is some strategy here that you all can employ. And this is why understanding credit and the influences on our credit score are so important, right? That closing a credit card could lower our score. Opening another credit card could increase our limit and lower our utilization rate, which could benefit the score, right? So what's going to be the right move for you? Yes, Aiden also said too, another way to lower your utilization rate is to request a higher credit limit. Perfect. Actually, that's the better piece. That's the better recommendation, right? Before opening up another credit card, maybe you can just talk to your credit card company and have that amount increased, right? They are more willing to work with consumers than we sometimes give them credit for, right? So let's wrap it up. We've got those one-on-one appointments I mentioned and a whole host of other free services that students, staff, and faculty can engage in. Students have most access. Staff and faculty have access to some of these other resources aside from one-on-one appointments. Although, Aiden, if you've got the PNC link, drop that in. Our staff and faculty can partner with PNC for financial literacy consultations, kind of like what we do. So there's a little bit of everything for everyone.